Hey guys, a lot of high yield investors are going to be wrecked when the market corrects or crashes whenever that happens. Don't be that guy, don't be that girl. Get yourself prepared for the inevitable. Know the weaknesses of the high yield funds that we hold and get ready for the inevitable crash or correction. This is Mike, the Tactical Stock Scalper. All right. I've seen so many new investors come into Discord servers, YouTube, Reddit, etc. that have just gotten in the market the last couple of years and are into high yield funds, whatever high yield means to you. All they know is that the market goes up. They don't know anything about prolonged drawdowns and long-term market corrections that can last a year, 2 or 3. They have no idea about this because their own experiences have only shown them that the market only goes up. So if you're not prepared, you will get wrecked. And I'm telling you, we will see some people wrecked when this market corrects, which may be coming sooner than you think. So let me start here. No one can call a top. There's no. If someone says this is the top of the stock market, don't listen to them. They have no idea what they're talking about because there's no way to call a top because there's no historical data to go off of. Calling a bottom during a correction or crash is way easier. You can look at past levels of support where there's been a ton of buys and money coming in to the market that provided some stabilization, allowed the chart to bounce and the market to go back up. We don't have that when there's no historical data to go off of. So when will the market correction happen? I don't know, but there are some warning signs. First is the 20 EMA on a daily time frame or the weekly time frame. Put that on your chart. And when that breaks, that'll be your first warning sign. There are several warning signs on the way down that it's getting deeper and bigger, but that would kind of be your first. Okay, I love my high yield funds, but they don't come without weaknesses, okay? And the weaknesses, when there will be a crash or drawdown, these will have an issue recovering, most of them. Like funds like AMZ and MSFO, they follow their underlying really, really well. And at times, outperform the underlying. Many high yield funds do not. They don't come close to the growth, right, that the underlyings provide. So when it goes down, we will catch all the downside, just like any other stock. The problem with high yield funds, okay, and the hitch and the giddy up here is the recovery. Because it will drop so hard, your price will be so low, the recovery just won't be there because it will be capped due to the covered call, right? So it's important knowing this and knowing the weaknesses of the funds you hold to help yourself get some cushion and prevent that. And let's talk about how important and how to build a cash position to get ready for the inevitable. Before I begin, I got a membership group. It's only $4 a month. I show my trades live in there. You can follow my trades. Since the membership group has started like 2.5, 3 months ago, I'm 26-0 in my swing trades that I share with the membership group. I haven't lost one. Not one freaking trade on my swing trades in 3 months. Okay, so let's start here. First, learn, and I'll leave a link in the description if you want to join the membership group. First, learn how to trade, doggone it. That way you can trade in any market condition. You can make money by using leveraged funds, inverse funds, buying puts, shorting it, selling covered calls, whatever. That you can make money as the market goes down. It's so important to learn that skill. Not only to make money as the market goes up, but even more important, to learn how to make money when the market goes down. Okay, next, that's one way to build cash, right? The next is when something gets over your cost basis, Don't put 100% of the dividends right back into it. Buying above your cost basis, that is profit. That's free money. When you get a dividend, it's above your cost basis. That's all free. So what we've been doing for the last several months is building a big cash position, getting ready and preparing. Just like ants or squirrels or whatever, right? When times are good, you go bury something and put it away. That way you're ready for the winter. Well, when the market dumps and drops, I have a cash position that I'll be ready to utilize, either to A, buy wonderful opportunities, or B, since I'm semi-retired now, pull that cash and help live off of it. Okay. So when something's above your cost basis, pull the dividends, my friends. Okay? That's it. Or put a little percentage back in. Now you're going to hear people say, man, if I pull all the dividends above my cost basis, my money's not working for me. It will work for you at the time you deploy it. Just because it's not working for you right then doesn't mean it won't work for you then. And I tend to argue that it'll work even better. You'll get even more return by having the cash and buying things really cheap. Okay, next. Okay, so we talked about taking profits. We talked about trading. Okay, what about core compounding? That's even a simpler way to do it, right? When something's above your cost basis, don't pull the whole fund, or just pull off some profit, right? From not only the dividend, but the share price appreciation. Pull that, put it in cash, and then you can utilize that to buy even more shares at a cheaper price, live off of it, build your core position, and get that average price lower. That's a wonderful thing about buying the dip and core compounding and things like that is it brings your average price down. So when the market does go back up, it's above your cost basis and all the dividends are profit or free money, as I like to call it. Okay, next. When the markets do correct, and they will, it's not an if, it's a when. When they do correct, the best funds you can buy are market-related funds. Why is that? Why is that? Because the market will always recover. Not all individual stocks will recover, my friends, right? But the market will recover. It always has and always will. I don't care if it's a down month, year, 5 years, decade, doesn't matter. The market always recovers. So, knowing that, if you buy market-related funds, when the market starts dropping, like right now, for instance, I don't own any Round Hill funds. I don't own JEPQ or JEPI, but I plan to. I definitely want to. It just makes more sense for me to have yield max funds right now, making more total return while the market's ripping. However, when the markets start dropping and go really low, that's when I will go in and buy the market-related funds like QDTE, XDTE, things like that. Because not only will the price be cheaper, we'll catch massive share price appreciation on the way up, like JEPQ and JEPI, stuff like that. FEPI, all of those things, right? And you'll also have the dividends. So when the market corrects or drops, I highly recommend start checking out those market-related funds. As for me, I got to wait on those until we get some kind of serious dip. It just doesn't make sense for me with total returns being so high in Nvidia, YMAG, AMZ, SQY, to go in and buy a market-related fund right now. I'm going to wait, keep building my cash position, and then when it does correct, I'll be right there in all those market-related funds, because those will be keen. This is Mike, the Tactical Stock Scalper, out.